If you've ever opened a brokerage app during a bad week, you know the feeling. A flood of red numbers, downward arrows, and headlines suggesting your wealth is vaporizing. We naturally assume those flashing numbers are objective data points. We treat the stock market like a flawless calculator, accurately judging the quality of our financial decisions in real time. But treating the screen as a rational judge creates a trap. Letting price swings dictate your mood hands over control of your capital to market volatility. The real danger out there has nothing to do with math. Selling at the bottom happens because an investor failed to defend their own mind against a psychological ambush. In 1949, an investor named Benjamin Graham realized this problem and laid out a disciplined method to solve it. His solution worked so well that Warren Buffett, the most successful investor in history, still calls Graham's philosophy the best ever written on the subject. Graham proposed a different way to look at the ticker. He asked you to stop thinking of the market as a cold machine and instead imagine you co-own a business with a deeply emotional partner named Mr. Market. Graham's partner is driven by feeling, not logic, and recognizing that price swings are the opponent's mood rather than his wisdom changes the mechanics of the game. Picture this partner knocking on your door every morning. He has one job. He shouts a brand new price at you, offering to buy your share of the business or sell you his. Some days he is manic. During these phases, he sees no ceiling and demands outrageously high prices for the assets you share. Other days, he is terrified. He stares at the red numbers, convinced the world is ending, and offers to give his stake away for pennies on the rupee. He aims for emotional contagion, infecting you with his panic or greed until you abandon your own strategy. The defense against this is disciplined detachment. You must remember that this partner exists to serve your orders, not to instruct your beliefs. To survive, you must calculate the true worth of the business entirely on your own, before your partner ever opens his mouth to shout a price. But calculating that true worth exposes a vulnerability. Human estimates are often wrong, and the future is foggy. To defend against this uncertainty, Graham introduced the three most critical words in investing: the margin of safety. The margin of safety is the gap between what a business is worth and the lower price you pay. This gap absorbs mistakes and bad luck. Pay full price for a perfect outcome, and you leave no room for error. Graham's goal was to render an accurate estimate of the future unnecessary. Buying at a discount creates an armor thick enough to absorb the surprises that a forecast can't predict. Imagine a steady consumer goods company with predictable sales growth. You analyze the company and determines its intrinsic value is 100 rupees. Mr. Market panics, offering the share for 65 rupees. That 35 rupee difference is your margin of safety. Months later, euphoria hits. He quotes 140 rupees, well above what it's worth. An amateur freezes when the price drops to 65 or chases the hype at 140. A disciplined investor buys the 65 rupee cushion and ignores the 140 rupee trap. By anchoring to reality, you transform your opponent's mood swings from a threat into a tactical advantage. You don't need to be a professional stock picker to use this discipline. It applies to broad market index funds. If you have an automated monthly investment, Mr. Market's gloomy days work for you. Your fixed amount buys more units when he is in a panic. This structural cushion applies beyond the exchange. It is the reason you hold an emergency fund and refuse the maximum mortgage the bank offers. Financial blow-ups usually happen to those who left no margin for error. The next time the markets bleed and your portfolio turns red, force yourself to sit with that silence before reacting. Ask yourself, did the actual business change, or is my partner just having a bad day?